Hi everyone, happy new year 2024. Welcome back to Signal or Noise. Charlie Bilello here. Joining me as always, Peter Mallouk. Peter, it's that time of year where people are thinking about what's going to happen this year. And on Wall Street, you know their favorite game. That is to focus on forecast. What will happen this year? What's the price target? How did people do last year with that? Not so well. If we look at the biggest Wall Street banks, every single one of them fell short of where the S&P 500 actually ended the year. The S&P ended the year 4,770. That's over 200 points higher than the highest forecast and 18% higher than the average forecast of these strategists. Kind of blows your mind. This has been kind of a consistent theme in recent years where the year prior they were actually above. Every single one was above the level in 2022. This year in 2023, everyone below. And playing this game of forecasting is a lot of fun for Wall Street banks, gets a lot of attention. But for investors, really, their focus should be on something else, shouldn't it? It shouldn't be on thinking, where is the S&P going to end the year and then taking some action based on that.
I mean, the two best prediction sets of the year are the prediction of the stock market and the prediction of where interest rates will be, and they are always wrong. And so it's always just a valuable lesson for investors to not get too cute with predictions, or really not to pay attention to predictions at all. And what I love about it is if you can't predict anything, then you have to make the investing about yourself, right? About what do I need and when do I need it, and building a needs-based portfolio. So it's an affirmation at the beginning of every year that predictions are worthless. The JP Morgan report just came out. On the cover is a picture of like 15 or 20 bears. Right? So, and it's good to be able to look at that and go, you know what? The Any predictions are totally worthless. Let's make
But
sure
there
that
were
the
30,
portfolio is
Peter, there were
covered for
30
you.
bears on the cover the year before, right?
Is
So maybe that's a signal.
less bearish, I guess. So, I mean, I just view it's a great affirmation for needs-based investing, which is the philosophy we've always had and what every prudent investor should have, which is what do I need and when do I need it? And let's ignore all the noise and make sure my investments match up with my needs.
Okay, so what I like to say is, instead of making a forecast, come up with a resolution. It's a new year, and that resolution shouldn't just be for the short run. As an investor, we're always talking about long run. So how about thinking about resolutions you can make as an investor for life? So I put together 4 resolutions here that I think about every year. Let's start with number 1, and that's embrace risk. I updated this through the end of 2023. You can see here, stock market since 1928, 9.8% per year. 10-year treasury bond, 4.6% per year. Cash, which I'm using the 3-month treasury bill, at 3.3% per year. If you're looking at this chart as an investor, this is really telling you, in the long run, view risk as your best friend here, because that's why you're being rewarded with this higher return.
Yeah, there's some risks that are rewarded, some are not. Like, so for example, uh, picking meme stocks or buying pictures of rocks online. I saw a lot of people go, oh, well, I'm taking more risk, I'm going to get more reward. Not exactly how it works. But if you're a diversified stock market investor and you're comparing it to being a diversified bond investor, that stock market risk of volatility is going to be rewarded. Historically, it's been rewarded over long periods of time, over and over and over again. If you're willing to pay the price of volatility, you have an overwhelming probability of being rewarded for taking that risk.
And here's the ultimate reason, right, as an investor, that you should be thinking about investing, particularly in stocks over long periods of time. It's the fact that there's going to be inflation. We're going to talk about national debt a little bit later, but that's one prediction I think I will make this year. There will be inflation this year. The question is how much. So the value of your dollar in your pocket is going to be going down. If we look at the last 30 years, you've lost half of the value of your dollar if you're just putting under your mattress or leaving it in a checking account. If you look at the S&P 500, and no doubt this has been pretty good 30 years for the stock market, but I think it's instructive here. After inflation, you're looking at a 793% return. So It's kind of counterintuitive, but that higher risk that you have in the stock market, the prospect of loss, really over long periods of time, the bigger risk is doing nothing, is not investing because now you're eroding your purchasing power because of inflation.
There's all these different narratives about investing. Oh, the stock market runs over, or small cap versus large cap, or international versus US, or what's going to happen when interest rates are up or down. And no one wants to look at like what happens all the time. And what a lot of people have very high confidence will continue to happen, which is the value of a dollar is going to diminish. That the dollars that you have in your hands today will not buy as much stuff 10 years from now and 20 years from now. People have to just accept that there's inflation. And the only question is, how long will periods of deflation persist? It's usually not very long. And when there is inflation, how high will it be? And if we invest in the market, part of the return comes from inflation. So you don't just preserve your purchasing power, you exceed it in terms of the real return on your dollars, just like this chart. I mean, this is my favorite chart you put out recently. It was the first one that I posted out of the set that you sent out because it just tells such an incredible story. If you hold on to your dollars, you're going to lose the purchasing power. If you put your dollars in the market, you're going to retain your purchasing power and then some.
Yeah, absolutely. I put out that piece, put these charts on your wall, and this is my number one chart, just having it up there as a reminder. Might not happen in any given year, but over 20, 30-year periods, your best hedge against inflation has been the stock market. And let's move to number two, resolution, playing the long game. There's going to be a lot of focus. It's already started, Peter. The market was down on the first trading day of the year. A lot of people talking about what does that mean. We have this so-called Santa rally that if it doesn't happen, some people say that's bearish, which is the last 5 days of the prior trading year and the first two trading days of the new year. And if there's typically it's typically have strong returns, and they're saying if that's not strong, that means something. And of course, that's absolute nonsense. But the broader point here, you've talked about the comparison of investing to a casino and how investing is totally different than playing in a casino. And I think this chart really illustrates that.
Yeah, in the casino, the longer you play, the more likely you are to lose. That's why when you're losing, the casino doesn't. When you're winning, the casino doesn't throw you out. They give you free buffet and free hotel room and invite you to come back. Then the longer you play, the more likely you are to lose. In the stock market, as this chart shows, the longer you play, the more likely you're going to win. The longer you stay in the game, the more likely you're going to win. To the point where it becomes as close to the word as guaranteed as we can use.
Yep, never been a 20-year period where stocks haven't been higher. And more importantly, if you zoom out and stop focusing on the short run, even though you can have big days in the market could be up 5% in a given day or down 5%. And that's enticing, right, to the gamblers in us. And if you look at individual stocks, there's always a stock moving up 20% or down 20%. And that seems like, oh, I could get the timing right, just focus on the short run, get a quick hit and keep compounding that. No one can do that. But if you zoom out, you don't have to play that game because the long-term compounding returns are so rewarding, right? So
Right.
no matter how good that short-term period is, it's not going to be as good as that 20 or 30-year return that you get. Median total return for the S&P 500 over 10 years, 170%, 20 years, 720%, 30 years, 2,173%. And you can't fathom that. You got to put it in a spreadsheet to tell you what that would turn an initial investment into. But playing the long game is something as an investor that should be a resolution for life. Forget about that short run. Think about the long run. Number three, diversify, diversify, diversify. And diversification in the short run is always a four-letter word. People hate diversification because there's something that's so glaringly obvious in hindsight that's outperforming everything else. And last year, of course, Peter, that was that magnificent seven, technology sector up 56%. And if I'm doing a CNBC interview with you right now, I'd say, Peter Mallouk, we have Peter Mallouk here. He's going to tell us what's going to be the best performing sector in 2024. Peter, give us your top pick for 2024. What's it going to be?
And I get that. So every month when I go on,
Yep.
Um, some stations will just let you talk about the markets, but oftentimes they want your picks and they want them with conviction. And then you go on air and you have to explain, why you can't have conviction around any of the picks. But they really want, I mean, they really want that, right? Because obviously they're in the business of making money for their shareholders. They have a fiduciary duty to make money for their shareholders. To do that, they've got to sell ads. To sell ads, they have to have people watching. To get people watching, they've got to have a lot of excitement, hyperbole, and predictions. And the correct answer is diversify because you don't know what sector is going to perform the best at any given time.
That's
And
so boring.
yeah, it's
That's
so boring. It's so incredibly boring. Yeah.
that's why I have to keep saying no to these things. But the
I
fascinating
do have to. I think this is very funny, by the way. That just for our listeners, that I'd say about once every couple weeks, Charlie gets a request to be on CNBC or if I set one of these stations, and I think 100% of the time, without exception, your answer is no, thank you. Like you're just not your thing at all.
Yeah, well, you always say you gotta learn how to say no to things that are not enhancing things for you, and that doesn't mean
Right.
I'll never do it again, but I won't go on there and answer those kind of questions. Definitely
Well,
not. So,
good for you.
technology sector 2023, 56%. Peter, here's an interesting stat. Maybe you didn't know this. It was the best year for technology stocks since 1999. Okay.
Yeah.
We all know 1999, that was a pretty good year for technology stocks. So the temptation is, hey, why diversify? Why be in any other sector? We know that biggest technology stocks, we use their products every day. But if we look at this table going back to 1999, you can see technology stocks not always the winner. If we look at 2022, you could see energy stocks were actually the best performing sector. 2021 it was energy stocks as well. You could see it goes back and forth from year to year, and absolutely nobody can tell you what the best performing sector is going to be this year. If we look at technology over the long run, this is a chart showing you technology versus the S&P 500. You could see boom during the 90s, then bust, and then a period of kind of sideways relative to the market for
Hmm.
over a decade. People forget that. And then the recent boom again. Now, can this continue to go up? Of course it can. Nothing's impossible. Technology is not going away. Its share of the S&P could certainly get bigger. But measure those expectations. Right? If you just had the best year since 1999, if we look at all the magnificent seven stocks up 50, 60, doubling, some of them tripling, that shouldn't be your base case expectation. And so, as an investor, the advantage you have is you don't have to pick, you don't have to play the CNBC game. You don't have to pick any one of these sectors. You can get them all, right? Buying the index. And by buying them all, you don't have to predict. You'll get whatever that average is at the end of the year. If something does well, you'll benefit from that. If something doesn't do well, well, you won't be 100% concentrated in that.
Right, and if you for your large cap US position, you have the S&P 500, well, 25% of your money, 30 something percent of your money is already in these big tech stocks, just a handful of them. So you're already dramatically and substantively overweighted towards big US tech. I mean, almost every creative planning client is overweighted in big US tech. And so the good news is they participate in that rally, but they would feel it if that rally turns too. Oftentimes people see a position like the S&P 500 and go, well, okay, I've got that. Now I've got to go buy my big tech. Well, you've got your big tech. It's the biggest part of that. The Apple, Microsoft, Google, they're bigger than the bottom 100, 200, 300 companies in the S&P 500 combined. So you've got that weighting that you need already.
It's there, and so you hopefully it does continue to do well. But risk management requires you to say maybe it won't do it. Maybe there'll be
Yeah.
another 2022. We don't know, but it's coming at some point, and then you'll be thankful you had something else in your portfolio. So diversify, diversify, diversify. Even though it's going to be painful, there's going to be something out there that's outperforming. That's just the nature of markets. Resolution number 4: focus on what you can control, and what you can't control as an investor, Peter, are the returns.
Yeah.
As much as you will the S&P to be up 20% again this year, and I added the 2023 if you're looking for it there in the 20 to 30% column. I want it to be in that bucket again this year. That doesn't mean anything. That doesn't mean it's going to happen. So
Right.
you have no control where 2024 is going to be on this on this pyramid here, and what you can control are your habits and your behavior. And if we look at your behavior as an investor, there's this thing, and we covered it on an episode last year called the behavior gap. And investors tend to behave pretty badly when they're reacting to their emotions, when they're buying high because they have greed, or they're selling low because they have fear. And we can see here the difference between investor returns and fund returns. That gap, that behavior gap, is something you can control simply by not performance chasing.
Yeah, I mean, absolutely. My favorite chart's the one before this. I have it at the front of the Five Mistakes Every Investor Makes book, which was the first book I put out. And to me, this chart resonates with me because it's basically looks as if the market is flipping you off. It just looks like it's basically saying, just try to guess where next year is going to land. The distribution is unpredictable. So, your theme, I couldn't agree with it more. And it's basically the thesis of everything we talk about with all of investing: focus on what you can control.
And talking about habits and behavior, we covered this back in October. Some of the viewers will remember active, and we covered it also in July. Active managers, just their tendency to become fearful after the market goes down. So we had that 10% correction September, October. Active managers cut their exposure. They had less than 25% exposure to stocks. And then lo and behold, S&P has this enormous rally that we'll talk about later in signal or noise. And what do active managers do? They ramp that exposure back up, and now they're leveraged long once again. Now,
Yeah.
as an investor, just view this as something you don't want to be doing. But this is, if you were using your emotions as a guide of how to change your exposure, this is exactly what you would be doing. Right? You'd be getting fearful. Oh, interest rates are rising. There's problems. There's a threat of war. Let me get out of stocks. And then by the end of the year, everything looks good. No recession. Markets are higher. Let me get back in. This is something you don't want to be doing as an investor. So 2024, one more prediction for me, Peter. In this drawdown column, there will be another drawdown. There will be another correction. It's going to be of some magnitude that we can't predict, but there will be a drawdown again. And I know investors are feeling better about the future because stocks have run up a lot. But don't forget, the reason why you have that 10% long term return is because of this drawdown column. Every single year, there's risk. And even if you can't see it, it's still there.
Yeah. One thing you can almost always count on is every 12 to 15 months, a double digit percentage drawdown. It's just going to happen.
And 2023 is really was kind of a textbook year for that. We saw
Yeah.
that 10% drawdown, volatility was kind of right in the middle. It was kind of just your standard year, and yet the stock market was up 26%. Right, so
Yeah.
which just
Right.
proves, right, it's not an impediment to that return, that drawdown. It's the reason why you actually get it at the end of the day. Okay, so that's 4 resolutions to focus on for life. Number 2, I want to talk about actual real life. So investing obviously isn't everything. People make resolutions for the new year, and I want to talk about habits here. But first, Peter, this is a list that probably looks familiar to you. These are the top New Year's resolutions for people: lose weight, get back in shape, eat healthier, be less stressed, get more sleep, spend more quality time with your family, read more, get out of debt, find a better job, get organized, learn something new. All great resolutions, right? This is a pretty good list. The problem, as you know, very few people stick with these for very long. I think I read somewhere that by the end of January, most people have given up on these resolutions.
Oh, do you think it goes that long? I mean,
Probably
like,
not.
like I tell myself every Christmas Eve, okay, I'm going to eat a little bit less this season. I surrender like within 2 days. It's very hard to make some radical changes, right? And I'm surprised to
Absolutely.
see on this list, by the way. To me, read more really surprises me. I don't know why. It just feels like it doesn't fit with the rest of these things. Weight, health, sleep, stress, all those things, and read more in there. That's interesting. That's in the top 10 New Year's resolutions.
Yeah, I think that goes along with learning something new, and that's probably one very quickly, as you said, that people probably don't follow
Right.
through on. Hopefully they will. And we're going to talk about a few books that we recommend in a little bit. But what's an alternative to this? This is something I figured out a while ago. Having these resolutions is great. These are lofty goals. We can all benefit from them. But you need to really break them down into something that's more repeatable. And that's creating a habit based on this. So, as Epictetus said, if you want to do something, make a habit of it. And my personal way of doing that is to keep a habit diary. And here I just put an example. These aren't my habits, although they're somewhat similar. And I do enjoy checking these boxes off every day. Some people make fun of me and my family for this, but it
It's
actually
funny.
works. So if you want to eat healthier, that's a great goal. How do you do that? Well, you can start by eating more fruits and vegetables. Check that off every day. You want to get in shape, great goal. But if you haven't done anything in years, maybe start by walking around the block, right? And then take it from there, right? Couch to 5K. Get more organized. You can make your bed every day. That's a good start. Clean your desk. How's your desk looking there, Peter? Is it clear off?
I'm kind of an organization freak, so I'm covered
Okay.
in that
You
category.
don't need this one. Read more books. Start by reading 10 minutes a day, and on and on and on. Right.
Right.
So this is something to me that's been very helpful. Just make yourself accountable, and for some crazy reason creating a checklist and wanting to see that box being filled does it. And an extra thing I would say is talk to someone about it, and if possible have them join you on it, because having someone else to hold you accountable is huge. So we've seen people like counting their steps together. That's great, right? They're trying to hit that goal together. So whenever possible, I don't know if you do that with anyone, Peter, try to involve someone else. And now you're feeling like I have to do it, otherwise I'm not fulfilling my promise to them.
So tell me your number one habit. Like what's your main that I wouldn't just naturally think about? Like is there anything pretty unique?
Just no, just do something
Hmm.
every day in terms of exercise. And regardless, I was sick over the last week. I'm getting over it now, but I didn't do my normal exercise routine, but I did something. I forced myself do some push-ups here. Do whatever you can. You don't have to do the same thing, and don't feel like a failure. Don't feel like I shouldn't do it at all because I don't have the time to go out for a 5 mile run, or I don't have time to go to the gym for an hour. Do 10 minutes, do 20 minutes, better than nothing. And you could apply that, I think, to anything. You don't have, there's only so much time in the day. Take whatever time that has and check off that box. So just consistency for me in terms of exercising. I think like I feel better when I do physical activity, whatever it is. I feel better. I never at the end of it say, "Oh man, I wish I didn't do that."
That's
So
good.
for me, how about you? What's number one for you?
I am not really great at setting aside time to do a lot of things. So I do like very like 25 to 30 minutes of exercise a day and that's it. I'm not and I you know what, when it's done, I'm like I could have done without that. I never feel like amazing. I just do it because I have to. And when we're in Kansas City when the weather's nice, I'd much rather, be outside and walking the dogs and walking with my wife and things like that. So I have these little cheat systems to like make sure that I'm not totally like not moving around ever. So for example, I'm doing this at my desk, and my desk, everybody's desk at Creative Planning is a stand up desk. You can have it go up and down. I have only stood at my desk. I've never once ever sat at my desk. Never happened. Now I have client meetings and I go sit at a table with the clients. But when I'm on podcasts, on TV, just where I am 80% of the time, just sitting or standing here at my desk, I'm behind the desk, I'm standing. I also never take the elevator. I've never taken the elevator once at creative planning. So we're in a 5-story building. I'm on the 5th floor. Probably go up and down 4 times a day besides, just to come in, go to lunch, go see other people. And I've never once gotten on the elevator ever for any reason. Even if I'm running a little late, I take those stairs. And so it forces me to do those steps, 5 stories up, 5 stories down about 5 times a day. And I know every day doesn't matter, but it's kind of like if I eat a donut today, it doesn't matter. If I eat one every day, it's pretty bad. I think if I do these 5 stories every day all year, probably is helping me incrementally a little bit. So I try to have those little things like that built into my day, whether it's exercise or other things that force me to get reasonably a better probability of a good outcome, whether it comes to health or anything else. So we got a
Yeah,
lot of
those
weird systems in
not
place.
weird, yeah, little tricks, right?
Yeah.
And if you put in this box here, stand up at my desk, you'd have it checked off every single day,
Right.
right? I mean, that's so for anyone that wants to, follow along with this, I'm going to create a PDF and I'll have a link in the show notes for you to print this out. And for some reason, having like a physical printout today in today's world rather than an app on your phone, I don't know, there's something about it. Put it on your wall, and you just feel good at the end of the day. And if you didn't do it that day, you get back into it tomorrow. Just don't let
Yeah.
that gap. I think that's why visually looking at that is just a helpful thing. So your habits influence your destiny. And I just love this quote. So we'll end this section with this: people do not decide their futures, they decide their habits, and their habits decide their futures. So a lot of important goals that people have for 2024, and uh, they're not preordained. They're not your destiny isn't set. Your habits that you're going to do every single day are going to help move you in that direction or not move you there. It's not preordained, and so get after it and make a habit of it. All right, so new year, Peter, and new books. And I have a habit of reading a lot, and I know you do as well. And this month we have a few new books for people to take a look at. I'm going to start with your book recommendation here. Look at that cover there. That eye is not looking very friendly there. The Fund, Ray Dalio, Bridgewater Associates, and the Unraveling of a Wall Street Legend. Tell me about this book. Um, Ray Dalio, everyone knows, founder of Bridgewater, biggest hedge fund in the world. At one point, I'm not sure if it still is, but uh, what'd you take away from this read?
I had two partners here, Mark Henke and Bob McCarthy, that recommended I read this book, and I got it. And I mean, I could not put it down. I mean, it first of all, I believe it to be accurate is total hit piece, right? That it's the whole book is basically everything that is wrong with Bridgewater, and I don't think there's a kind word about it in there at all. And of course, Bridgewater has some of the best performing funds in the space, but I'm not a hedge fund believer in general. I think I'm well on the record for that. But what's fascinating about this book was the way the internal environment works at Bridgewater. That basically they have this idea of radical transparency, which Ray Dalio talks openly about. I've read Principles. He talks about that in there, where everything should be open all the time. So there's cameras everywhere. If anything goes wrong, there's an investigator put on an investigative committee. Then there's a trial, and the people come in the room and they're put on trial. The employees rate each other in real time. Like if you and I are having a dialogue and there's 7 people in the room or people are watching us record this, they'll all be typing in to note their notes
Tell me
and
how
rate,
bad I'm doing so far.
yeah, rating us all and rating how we're doing. And I mean, they've talked about one person was no longer at Bridgewater, and Ray and others had dinner with them, and they had made a crystal plaque and gave it to him as a gift, and it was his really poor ratings on a card. Like, and Ray told him something like, negative feedback is the greatest gift you can receive. I mean, it's just crazy. I mean, if you read the book, you can't put it down. It is absolutely insane. Now, I'm sure there have to be a lot of wonderful things happening at Bridgewater too. Obviously, there are really bright people there, and for periods of time, they have good performance. There are people staying for a long period of time. But boy, it does not sound healthy. It does not sound. It's unbelievable, really, to read about. And the book is a very, very quick read. I heard Amazon just bought it and is going to turn it into a limited series,
Oh
and so
wow!
I'm sure that's going to get even more attention than the book.
So not your takeaway was not to implement this creative plan.
Right. I mean, first of all, how it exists in today's world just blows my mind. But no, it sounds like the last thing I want to hear is what everybody is thinking every second of every day about anything. And it just sounds incredibly the environment sounds so incredibly unhealthy. It would be great to hear, kind of the counter to that. I've heard Ray Dalio say he's not going to address this book other than to say it wasn't fair and it's untrue and things like he said. I'm not going to address it again, but I would love for him to address it again, and share his point of view on all this. Yeah, but my takeaway is absolutely insane, and not a healthy environment, and doesn't sound like a healthy culture.
It's almost, and this could be applied to many different areas. It's almost as if, I remember when they were kind of almost lionizing that philosophy of radical transparency. And you often see this where you see someone who's very successful, they've done very well in a particular area, and then you say they're doing this strange, unusual thing. Well, that must be the reason why they were
Right.
successful as a firm,
Yeah.
right?
Yeah.
And correlation and causation, as we know, two different things. And the fact that they were so successful, maybe it was in spite of this. Maybe they would have been even better. We
Oh,
don't
it's
know.
100% in spite of it. It feels like one very, very big distraction. And I'm kind of reminded of all of, whenever somebody does really well, to your point, you get this, they'll interview them and they'll go, I get up at 4 and I read a book and then I go for a jog and da 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 da. And that's not really why they're successful. I mean, Warren Buffett gets up and he goes to McDonald's and he orders one of a couple McMuffin sandwiches and then he has a 2 liter of diet of actual Coke, not diet. I mean, like, look,
Yeah. Then
uh,
he goes to
and
Dairy Queen and
right, right. I mean, yeah, we tend to extrapolate too much from successful people and attribute it to other things. And the reality is, in the beginning, whether it was because of brilliance or luck or a combination, the fund did really, really well. And because of that, they raised a lot of money. And then all this other stuff they're doing probably had no impact or a negative impact on their outcomes.
Yeah, it's not to say that feedback isn't important, right? And learning to handle constructive criticism and feedback is important, but for that to be a
Right.
constant focus, that I just don't think many people are built to handle that in the right way. So if these were robots, I think like theoretically that might work great, and the robot
Yeah.
could
AI
filter out, oh,
machines. Right.
this is noise, this is actual important advice,
Right.
and they're not emotional, they don't take offense to anything. Maybe
Yeah.
that would work, but human beings were just not wired that
Correct.
way. And underneath it, I would just think it would start to build animosity and not just difficult to maintain a positive culture, just having that mindset.
Yeah.
Uh, but who knows? I know that Goldman Sachs for years used to do like a 360 review. So I think other firms, some of them have similar ideas, but implemented in different ways for
Well,
sure.
yeah, no, you obviously need, feedback up, down, sideways, and everything else. This is crazy. And the other part about this book is Jim Comey worked there. So he's running a lot of these investigations, and it was just the whole thing's so preposterous. I mean,
What was the craziest investigation
there was
in
one
there? Like
time
what, Comey?
Ray goes to the bathroom and he sees pee outside of the urinal, and so he demands an investigation, and there's a whole investigation and cameras and thinking about people reporting on each other in real time to get to the bottom of who is doing this. I mean, the whole thing is just there's story after story after story like this that would just absolutely blow any reader's mind, and it's going to be, I'm sure, number one on Amazon's watch list here in about a year. All
Yeah.
right,
Did
what's
he
your
say
book?
how? Just last question. Yeah. Did he say how he came up with all of these stories? Was there like an anonymous source, or
Oh, they're
did he
all
just do
reporting
it
on
from
each other
intel?
in real time, on everything. Like, the people were
Oh,
reporting on, like, the peas in the cafeteria, then there was an investigation, and then the peas would get replaced with fresher peas, and so, like, it was everybody was reporting on every single thing in the entire organization in real time and reporting on each other in real time, and there's cameras everywhere, and so somebody reports something for somebody, they or not hire, they had investigators on staff like Jim Comey, and then they'd go interview people and look at cameras, and it's so ridiculous. I mean, I can't even recount it without
yeah.
shaking my head.
It's hard to imagine. Like, how do you actually get work done at the end of the day,
Yeah,
focusing on
that's
urine
right.
gate and the rest of it.
Yeah.
All right. Here's here's my book, a little bit different. Destiny of the Republic. For anyone that likes history, Candace Miller, very good historian, but as a writer, just incredible talent because she writes nonfiction, writes history in a way that's just so engaging and readable. So it's just a crazy story. I don't know how many presidential biographies you've read, Peter, but this one was unbelievably interesting. You're talking about 1880, a period after the Civil War. People are not thinking about that time period very often. President gets assassinated or attempted assassination, gets shot, and this is a crazy, crazy situation. He doesn't die immediately. He gets shot. The bullet wound is there. 2 months go on, and it's just getting worse and worse. And doctors are coming in giving advice, the wrong advice.
Oh
So there's a
god.
lot of science and medicine involved, as you can imagine, at the time in 1880. Not the same as today in terms of what we would do in terms of medical technology. They would stick their fingers in to the wound, dirty hands, and try to probe finding the bullet. Right, just like crazy, crazy things. And at the same time, in Europe, just a few years before, Joseph Lister comes up with this, sanitation way to do surgeries, and the American surgeons don't believe it. They say this is hogwash. You got to have your hands dirty. That's a better method. And essentially, it's not the bullet that ends up killing him, Garfield. It's actually the malpractice of the doctors. And
Oh,
it's just a
yeah.
fascinating tale that goes through his life. He was an incredible president, Garfield. It's hard to imagine a president today who didn't want to be president, right? We know all of these, they want that
Mhm.
power. They want it. Garfield, and she tells the story very well, did not want to be president. It was actually he was giving a nomination speech for Sherman, and his speech was so good that people changed their votes and started voting for him. And after 30 something ballots, this is the way they did it back then, he became the Republican nominee and ended up winning. But Civil
Wow.
War hero, just an amazing character. And last point here is just a crazy kind of twist in the story. She also tells a parallel story of Alexander Graham Bell, who had just invented the telephone a few years earlier. Bell gets wind the president is shot. He's like, we need to do something. This is crazy. They're trying to find this bullet. They're making it worse. He invents like a the first what would become the first metal detector in like a few weeks and tests it out. Actually gets there. This is a picture from the Library of Congress. Gets there and uh, he can't find it, and he can't find it because the doctor who was in charge would only let him probe one area, which the doctor thought the bullet was, and it turns out it wasn't in that area. Bell
Oh.
was, incensed that he wouldn't let him go where he thought the bullet was. After he died, they did an autopsy, and they actually revealed it was not in the location that doctor said, and he could have. It was just a comedy of errors, but crazy that this actually went on back then. The president of the United States, first of all, the way he was, yeah, the way he was shot, you would, they were just treated as more normal people. He was walking in a train station, right? No security, all the rest of it. So if you like history, I went on probably too much here, but uh, great book, fantastic read, and definitely check it out. It reads like a novel. So signal or noise, Peter. This is two important topics here. Number one, this is fresh on people's minds because, believe it or not, we had one of the best November, December 2 month periods for the markets in history. S&P 500 up 13.9% in just those last 2 months of the year. Just incredible, right? After that, October, everyone was negative. We have this huge return. This is one of the biggest 2 month returns in history, going back to 1950. When you see something like this, you talk to people, they're excited naturally, right? When something's gone up this much in a short period of time, you get excited, right? And many stocks were up more than this. We know that small caps were up a huge in the 2 month period. Do you think something like this is a signal of anything or just noise?
Total noise. Total noise. And not indicative of anything that's going to happen. And we have no idea even how this quarter will turn out. How do you see this chart looking back?
So if we go back to 1950, this is kind of crazy here. This is the 12th biggest 2-month period for the S&P 500, and what jumps out here, Peter, is that many of the other top 2-month periods for stocks were actually the end of notorious bear markets, right? So you had the 73, 74 bear market, huge rally coming out of it. 2009, March, April 2009, April, May 2020. You have 1982, and on and on and on, 2002. So there's a few different ways I think you can look at this. One, you could say this is something similar, right? And we're off to the races here. This could be a multi year bull market kicking off out of the bear market. But I think the main takeaway for investors should be there's no signal that this is inherently bearish, right?
Right.
And it would be so easy if it was, right? Like to say, look, the market's gone up a lot, well,
Yeah.
now it's going to go down a lot. That simply isn't the case. What I like to say, it's the greatest paradox in markets that you can have a situation where when the market goes down a lot, so we showed early in the year how after 2022 we had one of the biggest short-term declines, and that tends to be bullish for the market going forward. You say, well, then the opposite has to be bearish. But the great paradox in markets is not only is an extreme decline tend to be bullish for stocks going forward, but also does an extreme in advance. And the reason for that comes back to human behavior of fear and greed. On the downside, investors get overly pessimistic, overly bearish, and then it snaps back in the other direction on the upside. There's a thing called momentum, and an object of motion tends to continue in motion, and upside tends to beget upside because investors have FOMO, they have fear of
Yeah.
missing out, and they attempt to pile in. So my overall takeaway from this is don't treat it's not a signal of bearishness, but don't treat it as a reason to get super excited, and definitely don't treat it as a reason to get super bearish.
Yeah.
And as an investor, you definitely don't want to be doing what the average investor is doing, which is getting more bullish today than a year ago. Stocks are 25% higher. We now have 32% more bulls than bears. Back in December 2022, 32% more bears than bulls. So yes, S&P 500 was up 26%. Terrific. Set your expectations much lower. The average return is 10%. If it does better than that, wouldn't be surprised. That's great. But definitely your base case expectation shouldn't be 20 to 30% per year. It could happen, but that shouldn't be your expectation. And you should be doing the opposite of this. If you're a long term investor, we get another 10, 20% decline. That's great, right? Because you're able to buy in. And what you said, I think, early in 2023, Peter, was, I think, great advice, huge for people that followed your advice then, which was this was, I think, in January 2023. You said, if you have a 401k and you're able to do this, you're able to front load it, we'll take advantage of this decline. We don't know that this is the low. We don't know if the market's going to be up or down this year, but you have this 20+% decline. Front load that, give yourself the advantage. Don't spread it out over the year if you can do it. Right.
Yeah.
That's something I think pretty good advice. If people followed that, they would have done pretty well with that last year. So, last signal or noise here. I can't believe that we're doing this already, but I promised everyone that when we hit a new milestone, you and I were going to talk about it again. And here we go. So we covered it in June, 32 trillion. We covered it again in September when we hit 33 trillion. And here we are, Peter, just squeezed in before the end of last year. Before we say whether there's signal or noise, unbelievable, isn't it? $34 trillion for the first time.
Now, this is getting truly stunning. And, from the signal or noise perspective, from the stock market perspective, it's just noise because this tends to be inflationary, which tends not to be negative for stocks over the long run. The stock market's separated from this in some ways, and definitely the performance this year will have nothing to do with the national debt. But over the long run, if you were to say, and that's not the question, but I've got to comment on it.
Oh,
Over the
please.
long run, you were to say, what is the single greatest threat to the United States? It's this chart. It's the national debt. That's the number one threat to the United States. And I remember a quote from a long time ago that the Soviets had, and they were talking about their three big rivals: Great Britain, Germany, and the United States. And they said we don't need to worry about Great Britain; they're going to expand themselves out of existence. We don't have to worry about Germany; they're going to militarize themselves out of existence. And we're not going to have to fire a bullet against the United States because they're going to spend themselves out of existence. And here we are,
Mm.
right? So if you were to say like when you're looking at an investment, when we look at an investment at creative planning, we make a case for why we want to buy it, but we also look at it and go, well, if this blows up, if this doesn't go well, what is the scenario with which things went wrong? And it forces you to look at things through a critical eye and avoid confirmation bias. I know Warren Buffett's a fan of that technique. I think if you were looking at the United States and said, okay, we're writing this story a few decades from now on how things collapsed, what would is the number one thing you would point at? It would probably be this. So this is something that at some point someone is going to have to get serious about. The problem is, and it's really not hyperbole to say, it's really like a credit card. The president and Congress, they don't face the consequences. They get all the upside of the spending now to, give all their buddies all their money and fund whatever it is they want to fund, whether it's wars or benefits or whatever it is that they want to fund. They don't bear the consequences of it today. But it is not hyperbole to say that credit card's got to be paid by somebody at some point. And right now, the reason the United States can get away with it is because we're considered the safest investment in the world. And everyone all over the world, Americans and other countries, are willing to loan money to the United States. And at some point, every country reaches a point where other countries say, this is not the safest place to park my money. And right now, another big blessing for the United States is there's not an alternative. China's not safer. Russia's not safer. India's not safer. The euro's not safer. In fact, as bad as the US has gotten, it's probably more safe than all these other currencies than it has been in decades. So it's benefiting from that chaos as well. But this is a price that's going to be a generational price that has to be paid. It's probably the thing that bothers me the most about the way our country operates. Sorry about that diatribe. That went far beyond the signal, but not a signal for the stock market over the short run.
Well, that I appreciate the diatribe. We need more of that, and you're correct. It hasn't been a signal. So worrying about the national debt as a citizen and as someone who has children who are going to inherit this debt, I think is a valid concern. As you said, someone's going to have to pay that back. But as an investor, it absolutely has not mattered. The S&P 500 has done 10% a year over the last 30 years, and US national debt's up 7x, up over 600%. That's a 7% per year increase in national debt. So it's not an impediment. And what I say is, this is, as a country, as a nation, this is a concern. But people often ask, well, how is it that the stock market couldn't be impacted by this? And ultimately, it could be, but that would have to be a very dire situation. It would have to be come to the point where this debt debt situation was a real crisis, to the point where you're starting to impair earnings of these companies. So as it stands today, that is not the situation. And as we know, S&P 500 companies, we saw last year profits hitting record highs, recovering from the decline in 2022. Companies adapted, companies cut costs, they got leaner, they navigated that high inflation period to produce a profit. So, unlike the US government, which we know they're going to generate a loss in 2024, we just don't know how much, companies, at least for now, are still trying to make a profit. So, that's why you can have the two situations. And what you don't want to see, Peter, as we talk about, is we don't know what the breaking point is. That's the problem here. There isn't a debt level. It's not 35 trillion. It's not 40 trillion. We don't know that specific number that's going to cause everything to go bad. But we don't want, I know enough to say we don't want to get close to that point. So I think simply it's not too late. Holding the line here, just being prudent here, trying to hold the line. It's not too late. Like, we shouldn't just throw our hands up and give up. Hold the line, spend money where it's appropriate, cut costs where it's appropriate, and just be responsible. Just do what the average American household does, which is don't borrow way in excess of what you're taking in, and we'll be okay. Because, as you said, our system of laws, our economy, our workforce, everything else is to our advantage. The government just stays in line and gets out of the way, in my view, things are going to be fine. So, as an investor, you can look at the national debt, but don't view it as a reason. It would have been a very poor decision over the last few decades to say, "Man, this national debt is going higher and higher. I should sell my stock portfolio." So that's it for this episode. Covered a lot of ground there, Peter. That was a fun one. Thanks everyone for joining us. If you're watching this on YouTube, we're also available on all the podcast platforms: Apple, Google, Spotify. So check us out there. And if you're an investor, a business owner, someone looking for legal, tax, any sort of advice at Creative Planning, we do it all. So take a look at the show notes. I have a link there. Set up a call, set up a meeting. We're in all 50 states. We do everything. Over 200 billion assets under management and advisement, and we're here to help. So check that out, and we'll see you next time on Signal or Noise.